Good morning, everyone, and a very warm welcome to our webinar today, all about pension calculations in Sage 50 Payroll. My name's Duncan. I'm one of your presenters for the session today, and as you can see, I am joined by my colleague Alice, who will be co-presenting this morning alongside me. Well, not alongside me literally, but in the same webinar. Let's now take a look at what we're going to cover in the webinar. So Alice is going to start things off with an introduction, explaining what factors affect how pension contributions are calculated and where to check these settings in Sage 50 Payroll. I'm then going to come back and run through some pension calculations with you. So I have 4 examples using a variety of settings, just so that you can fully understand how the calculations are done. And we even have one calculation for you guys to do at home to see if you can come up with the correct answer. So a bit of audience participation in today's webinar. Then back to Alice, who's going to run through a short quiz. So 4 multiple choice questions just to test your newfound pension calculation knowledge. And then at the end, I'll run through some of the further support available to you. And we'll give you that chance to ask any of your final questions in the Q&A. So with that said, it's now time for me to hand over to Alice, who's going to run through the introduction to today's webinar. So over to you, Alice.
Hello everybody, and thank you very much, Duncan. So with pension contributions in Sage 50 Payroll, we know that you can set up your scheme, you specify the contribution rate. But in these settings, you'll enter, for example, an employee contribution of 5%, and depending on the other settings in your pension scheme, the contributions probably won't be a straight 5% of the wage. There are multiple factors which will affect how the pension contributions are calculated. And some of these factors will include your employee's pensionable earnings, the pension contribution rates, so what's the percentage or the fixed amount. And just to note as well, if it is a fixed amount, that is a little bit different. Payroll uses that fixed value as the pension contribution instead. Also depends on whether your scheme deducts before or after tax, whether your scheme uses qualifying earnings for pensionable pay, and whether it's a salary sacrifice scheme or not. Now, I have linked an article talking a little bit more about these factors, but I am going to expand on them myself as well. So we'll start with pensionable earnings. Here we go. So pensionable earnings, it's the amount of pay that pension contributions are taken from, but not necessarily the employee's entire wage. And it can be a variety of things really. So an employee's pensionable earnings, it could be the basic salary before bonuses, overtime, commission, things like that. But it could actually instead be the employee's qualifying earnings, which we'll touch on in a moment. Or in fact, the employee's total earnings. So it does really depend on your pension scheme, what's going to be included in the pensionable earnings. But pensionable pay basically is just the amount of pay that the pension contributions are taken from. Now, I would advise that you check with your pension provider just to clarify what should be included or excluded from the employee's pensionable earnings for your specific pension scheme. And once you have checked that, you'll just need to make sure that you've got the relevant pay elements set up in payroll to be pensionable or not pensionable. For example, if your scheme requires the basic pay and bonuses to be pensionable, you'll need to make sure that all of those pay elements are set up appropriately. And I've got some examples of a pensionable and non-pensionable pay element just here on this slide. So in the middle of these screenshots, you'll see some tick boxes, and this is going to determine what the pay element is subject to. The screenshot on the left, this is my basic pay element, and those pension boxes that I've highlighted do have a tick in. So that means this pay element is pensionable. So it is subject to be included in the pension main, pension AVC or additional voluntary contributions, and salary sacrifice pension, and also included in the qualifying earnings too. Whereas the pay element on the right, this is my expenses pay element. It's not subject to any of those pension tick boxes. We can see they're cleared, and this means that this pay element is not pensionable. So it's not counted towards the calculations of the pension contributions or towards qualifying earnings either. It's also not subject to tax or national insurance or anything either. Next, I want to talk a little bit about the deduct before or after tax as well, as this does affect how the tax relief is given on the pension contributions. So if your scheme deducts before tax, otherwise known as a net pay tax relief arrangement, it'll take the pension contributions before the employee's tax is calculated, and the employee only pays tax on what's left. The employee's full contribution rate deducts in the pension calculation too. So with deduct before tax, if the employee's contribution rate was set to 5%, the full 5% of the pensionable pay is going to be the contributions. However, the other side of things, if your scheme deducts after tax, known as a relief at source arrangement, the contribution is calculated after tax and national insurance is. However much you earn, the pension provider adds tax relief to your pension pot at the basic tax rate of 20%. But because of that 20%, it means that only 80% of the employee's contribution rate deducts in payroll. So same example, if an employee's contribution rate was set to 5%, the actual contribution rate for the scheme that deducts after tax would be 4%, which is 80% of the 5%. Lots of percents going on, but hopefully it will become clear in those calculations a little bit later. And I will show you where these settings are in the programme shortly as well. But before I do, little recap on qualifying earnings too, for those of you who've not joined us on any of the pensions webinars just yet. So again, you will have to check with your provider whether your scheme uses qualifying earnings. So just in the bottom right there, I've just got a screenshot of the legislation for the qualifying earnings thresholds. We can see we've got the lower threshold, the earnings trigger, and the upper threshold for each different pay frequency. So if your pension scheme does use qualifying earnings, the employee's earnings between the lower and upper thresholds are their pensionable earnings and will be used to calculate the contributions. And Duncan will be going over this a little bit more shortly. But for a monthly employee, for example, any earnings between the lower threshold of 520 and the upper threshold of 4,189, that's going to be what the contributions are calculated on. And little reminder as well, so payments that count towards qualifying earnings, this includes things like salary, bonuses, commission, and all statutory payments really as well. And a little top tip from us, most payments that are subject to tax and national insurance are included in qualifying earnings. But of course, again, if you're unsure, just check with your pension provider or the gov.uk guidance as well. So most of these factors that affect the calculations can be checked in the pension scheme settings. And before I do pass you back to Duncan to go through those calculations, we are going to go into a demonstration and I'll show you exactly where to find them. So we'll just go full screen. I'll turn my camera off and bring up Payroll. So I'm in Payroll now. I'm actually going to go to my company tasks on the left-hand side. And I'm just going to go straight up to pension scheme. So second option there on the left. In here, you'll have some kind of default schemes set up by Payroll there. But we can see I've changed 2 of them there, and I've actually set up 2 schemes for myself here. First one, I'm just going to click Edit, and we'll take a little look at some of these settings. So first page in here, the Details tab, we can see we've got a couple of different tick boxes here. First one I'd like to point out is the Use Qualifying Earnings for Pensionable Pay. So this is one of the settings that affects the calculations, as if it's ticked, Payroll knows to use those upper and lower thresholds that I showed you a little bit earlier, and that'll affect the amount of pay that the contributions are calculated on. And at the bottom as well, if the scheme is salary sacrifice, this tick box will specify this, so Payroll knows to make any relevant changes. And the salary sacrifice pension contribution will show slightly differently in things like enter payments too. Just moving on to the Employee tab as well. This is where the scheme's contribution rate for the employee is specified, which of course will change the calculations depending on what's in here. So I can change that to a fixed amount or percentage. Mine's just 5%. But remember, if you do specify a fixed amount instead, and that is different, Payroll will use that fixed value as the pension contribution. And on the right too, there is a tick box called Deduct Before Tax. This is going to tell Payroll if the scheme deducts before tax, just tick that there. And that's when it's going to have that 20% basic tax relief. But since mine's unticked, it's a deduct after tax scheme. And this 5% rate would actually calculate in Payroll as 80%. So it's the 20% tax relief from the 5%. And as a result of this, the employee's contribution might look slightly less than you're expecting. But as you can see, most of the factors that affect the calculations are in here. We've got this tick box here, of course the contribution rate as well, and a couple of the tick boxes on this first details tab. You also though need to check which pay elements are set up to be included or excluded in the pensionable pay or included towards qualifying earnings. So let's click OK. We'll just close these pension schemes for now, and we'll take a look at those pay elements. Still in my company tasks, 2 options down from pension schemes. I'll just click on pay elements there. I've got 4 set up for this company at the moment. And if I just click on basic pay, I'll stick with the same examples I had on the slides. I'll click edit. And we can see those tick boxes which will specify what the payment is subject to. So my basic pay, I can see it is included towards the qualifying earnings. That's ticked there. And pension main, pension AVC or additional voluntary contributions, and salary sacrifice is ticked too. So this pay element is fully pensionable. And same example as the slides again, the expenses pay element, I'll click edit on that. And this one looking very different in here, no tick boxes at all. So this particular element is not going to be included in the qualifying earnings and isn't pensionable. It's also not subject to tax and national insurance. And this will very likely be the case for your expenses pay elements too. Most likely will not have ticks in here. But this is where you would come to check each pay element. And if you did need to edit any of them, of course, just click edit and change those settings as necessary. But one last thing I would like to show you before we go back to the slides and pass over to Duncan is for those of you who have a lot of pay elements. So I've not got too many, I've only got 4, but for those of you who've got quite a few, checking them individually is not going to be ideal. You probably want something that's going to save you a little bit of time. So I've actually got a report that I would like to show you, which will do just this. So I'm just going to go to my post-update reports above the employee list. I've already got it highlighted and favorited right there, but you can find it in the company section. And if I just scroll down, it's the payment types report that we need. So I'll preview this one and just show you what that looks like. With this report, it's going to give you a list of all of the pay elements that are set up in your company. You'll be easily kind of able to go down and check what they're subject to. So we've got a Y for yes or a tick in the boxes in the settings and an N for no. So basic pay, for example, I can see is subject to pension, pension AVC, is included in the qualifying earnings, and a yes for salary sacrifice as well. But you're just able to see what each payment is currently subject to, and if you need to change anything, you know exactly which ones you need to kind of go and edit already. So it could save you a little bit of time for those of you who've got a lot of pay elements. And that is the payment types report. But that is your introduction to pension calculations, a little bit of information about the factors that will affect them and where to find those settings as well. But it is now to pass over to Duncan, time to pass over to Duncan, who has got some calculations to show you. So it's over to you, Duncan.
Thank you very much, Alice. So just sharing my screen there. So we're going to try and put some of that theory that Alice has been through into practice. So I've got 4 examples of pension calculations that we're going to work through on a slide. And then I'm going to show you the exact same example within Payroll itself. So this way you'll see the theory, and then you'll see how Payroll actually does that calculation for you. So let's get straight on with our first example. Number 1, I've tried to start things off nice and simple. And for this first example, I am working with a pension scheme where the pensionable earnings are basic pay only. So it's not using qualifying earnings, it's all of basic pay, but it doesn't include things like overtime and bonuses. The contribution rates for my scheme are 6% for the employee contribution and 8% for the employer. And the tax relief is that the deduction is made before tax. In other words, it's a net pay arrangement. Now for this example, I have an employee who has total gross pay of £4,000 this period, made up of £3,500 basic and £500 of bonus. And their pay frequency is monthly. So whenever you do a calculation, your first step would be to establish the pensionable pay. So for this one, I know it's basic pay only and that the basic pay is £3,500. So that's our pensionable earnings. I then have my employee contribution. So 6% of 3,500 is £210. And because that is deducted before tax, that full 6% is what I'm going to deduct from my employee's pay before tax is calculated. And then the employer contribution, in this case, is £3,500 times 8%, which is £280. So that's the theory. Let's look at that in the program. So first thing I'll do here, just go full screen for you, is I'm going to show you the pension scheme settings for this scheme. So this is my scheme that uses basic pay only. You can see that the use qualifying earnings box is not ticked. Salary sacrifice is not ticked. I've got my 6% contribution for the employee, and I have deduct before tax ticked. And then the employer contribution, again, is set at 8%. So that's assigned to my first employee. And if I go into the enter payment screen for that employee, you can see we've got the 3,500 salary. I've got £500 bonus. So a total of £4,000 gross pay. Obviously just the salary is pensionable. So you can check the employee contribution on the summary tab. So that's my £210. And then to check the employer's contribution, I click employers at the bottom, and I can see that that one is £280. So the only thing that would change that amount of contribution in this case is if the salary amount changed. So if they get a salary increase, the pension contributions will increase in line. So that was example 1, starting off nice and simple. Second example, so we're going to mix it up a little bit now. This scheme is a scheme that uses qualifying earnings for pensionable pay. So that means that the lower and upper threshold come into play. So earnings between the lower and upper threshold are pensionable. And it does include things like overtime and bonuses, essentially any payment subject to tax and NI. Employee contributions in this example are 5%, and the employer contribution is 3%. But the tax relief for this one is that it's deducted after tax. So this is that relief at source arrangement. The employee's gross pay this period is £2,500, and they're only being paid basic for this period, which counts towards qualifying earnings, and the pay frequency is monthly. So it's that monthly lower and upper threshold that we need to reference. So same steps as before. First, we're going to establish the pensionable pay. So £2,500 are the payments that count towards qualifying earnings, but we then need to deduct the lower threshold. So it's not above the upper threshold. That 2,500 is between the thresholds already. So we just deduct the lower threshold to give us pensionable pay of £1,980. And then to work out the employee contribution, you take that pensionable pay, 1,980, multiplied by 5%, which gives us £99. But then we need to adjust for the tax relief. So that needs to be reduced by 20% or multiplied by 80%. And that brings us to an employee contribution of £79.20. So that's what we're going to deduct after tax. And the tax relief, that 20% we didn't deduct, is going to be claimed by the pension provider and put into the pension pot. Employer's contribution, a bit simpler, it's just the pensionable pay, 1980 times 3%, which in this case is £59.40. So let's take a look at that one in payroll. First of all, I'll show you the pension scheme settings. So it's actually this first scheme that I set up. It's a scheme that uses qualifying earnings for pensionable pay, so we've got that box ticked. We've got the employee contribution set at 5%, but deduct before tax is not ticked. So this is being deducted after tax. And the employer contribution here is 3% of the qualifying earnings. So monthly paid employee, it's actually this employee here. And I'm going to go into the enter payment screen. You can see their salary is the £2,500. And then checking the summary, that's our employee contribution, £79.20. And then the employer's contribution here at the bottom is the £59.40. So that all ties up with my manual calculation, but if there were any additional earnings, things like bonuses, we just pop a bonus amount in, you can see that the pension contributions do increase in this case because bonuses do count towards qualifying earnings, and my scheme uses qualifying earnings for pensionable pay. So that's the second example, quite a common setting with the more recent pension schemes as it uses qualifying earnings for pensionable pay. On to number 3 of 4. So for this one, I've used the exact same pension scheme. So it's a scheme that uses qualifying earnings for pensionable pay, and the contributions are 5% for the employee, 3% for the employer. Tax relief is deducting after tax. It's that relief at source arrangement. But for this employee, they've got gross pay of £1,040, made up of £540 basic and £500 commission, but their pay frequency is weekly. So for this calculation, we're going to reference the weekly lower and upper threshold. So to establish the pensionable pay, looking at the total qualifying earnings, that is above the upper threshold. So the pensionable pay is the earnings between the lower and upper threshold and doesn't include anything above that £967. So pensionable pay this week is £847, and that is what we're going to base the calculation on. We then have our employee contribution, so the £847 times 5%, which gives us £42.35. But because it's deducted after tax, that is further reduced by 20%. So we take 80% of £42.35, giving us the contribution of £33.88. Employer contribution is the pensionable pay, 847 times 3%, which is £25.41. So let's see this one in payroll. So I'm going to switch to my weekly payroll, just set my weekly pay date, which happens to be today's date. I've got the same scheme assigned. So if I look at the employee record and go on to the pensions tab, you can see it's pension scheme 1. It's that same scheme. I've got the relevant percentages entered here. And you can even check the pension settings on the pension information. So it's applied to qualifying earnings and it's deducted after tax. So let's have a look at the payments for the current period. got my £540 basic, and they've had a good week, £500 of commission. So total gross pay is 1,040. All of that counts towards qualifying earnings. When we go to the summary, here's our employee pension contribution, the £33.88, and the employer's contribution of £25.41. Now, for this scheme, effectively, that's the maximum contribution for a weekly paid employee because it uses qualifying earnings. So even if the commission was double, so if I put £1,000 commission in, you'll see there is no change to the pension contributions. They have remained the same at the maximum. But if they had half of that original commission, just the £250, taking their total pay below the upper threshold, you can see at this point, the pension contributions have started to reduce. So it's below the upper threshold if the commission has been reduced. So that is example number 3. I've got one more for you before we've got one for you to do at home. So example 4, we couldn't miss this out. This is a salary sacrifice scheme. So scheme settings for this one is that pensionable earnings are basic pay only. So this one is not using qualifying earnings. The employee salary sacrifice is 5% of their basic pay, and the employer's own contribution is 3%. And for tax relief, because it's a salary sacrifice arrangement, it means that the salary sacrifice is deducted before tax and national insurance, and that is then included and added on to the employer contribution. So it works slightly differently to non-salary sacrifice schemes. We'll work through the calculation though. So gross pay this period in this example is £2,750, which is all basic pay. Pay frequency is monthly. So we know that the pensionable pay in this case is basic pay of £2,750. And then to work out the employee salary sacrifice, we just take 5% of that amount. So that's the £137.50. The employer contribution is their 3% of the pensionable pay, which is £82.50, plus the amount that was given up by the employee as their salary sacrifice, the £137.50. So a total employer contribution of £220. And if you look at this on a pay slip, you won't see an employee contribution as such. You'll see a salary sacrifice, which is a negative payment, £137.50, reducing the gross pay for tax and national insurance. And then you can see there on the right-hand side, we've got the employer contribution, which is the total, including the salary sacrifice amount. So I do want to show you this one as well. So let's just jump back into payroll. Looking at the pension scheme setting first. So this is my salary sacrifice pension. Not using qualifying earnings. So it's going to look at the pay elements that I've flagged as pensionable. It is a salary sacrifice scheme, so I've ticked this box. We've specified the 5% salary sacrifice and the 3% employer contribution. So back to my monthly payrolls. Just going to set my monthly pay date as well. This was the employee with the salary sacrifice scheme. So I've got the basic pay, £2,750. Salary sacrifice is shown at this bar at the bottom, the £137.50. So reducing the gross pay for tax and NI. Checking the summary tab, there is no employee pension contribution. They had a salary sacrifice instead. But then looking at the employer's amount, that's where we see the full £220. So it's the employer's percentage plus the amount of the salary sacrifice. So just to compare and contrast those 3 different schemes that I've been using for my monthly paid employees, let's have a quick look at the pay slips. I'm going to bring them up on screen. So what we have here is the employee where it was deducted before tax, and it was a 6% and 8% contribution of the salary. So it's showing my employee and employer pension. We can see that the gross for tax is less than the total gross because this deduction has been made before tax. Second employee is where the qualifying earnings were pensionable and it was deducted after tax. So these are the contributions for employee and employer. But you can see the total gross pay is the same as the gross for tax because this deduction for the employee was taken after tax. And the third one there was the salary sacrifice. So negative value for the salary sacrifice pension. And then the employer pension shows the total amount being put in, including the amount sacrificed by the employee. So that was the last one that I'm going to take you through. But I did promise there's going to be a bit of audience participation. So we have a calculation for you. I'm going to give you a couple of minutes to have a go at this. And I'd like you to let us know what you think the answers are in the chat. So this is a scheme that uses qualifying earnings for pensionable pay. Now I've stuck with the minimum contributions. Employee is contributing 5% and the employer is putting in 3%. But this one is deducted after tax. It's a relief at source arrangement. So a calculation I want you to do is gross pay of £540, and all of that is basic pay, and the pay frequency is weekly. So I'll give you a couple of minutes to work out the pensionable pay in that scenario. And I've got the auto enrollment bands to help you out there. To work out the employee contribution, at 5% deducted after tax, and the employer contribution of 3%. So let us know what you think in the Q&A. And after a couple of minutes, I will work through the answer with you. So I will speak to you in a minute or two. Great, so we've got some answers coming through and I'm delighted to see that most of them look to be the correct answer. So if you're still working it out, do carry on, but I'm going to work through the solution to this one for you on screen. So pensionable earnings in this case is deducting the lower threshold for weekly paid employees. So £420 is your pensionable pay, which I think pretty much everyone has got. Employee contribution, 5% of 420 is £21. However, remember, it's being deducted after tax. So that is reduced by a further 20% to take account for the tax relief. So £21 times 80% is £16.80. That's what we're taking from the employee after tax. And then the employer contribution is your pensionable pay times 3%, which is your £12.60. So as I say, great work there. I think pretty much all of you have got that right. So that's it from me, but we're going to bring Alice back now for a little bit more audience participation. We've got a quick quiz for you. So back over to you, Alice.
Thanks so much, Duncan, and thanks for those demonstrations as well. Really handy to see those in the programme. I did see a lot of correct answers in the chat too, so well done to everyone there. So yeah, last section of the webinar is our short quiz. It is optional, but it would be great if you got involved. And we do this by running polls on your screen where you can select and submit the answer or answers. Then after a minute or so, I will reveal the poll results. I'll reveal the correct answer and kind of go from there. So I've got 4 questions coming your way. Let me just launch that first one now. And that should be coming up on your screen shortly. So question number 1 is, how are pension contributions deducted from an employee's pay? So just select your answer on that poll and click submit. How are pension contributions deducted from an employee's pay? Is it before tax, after tax, or it depends on the pension scheme? How are pension contributions deducted from an employee's pay? Before tax, after tax, or it depends on the pension scheme? Great, it looks like most people have voted now, so I'll leave that open a little bit longer. And I'll close that now and share those results. Great, so a little bit of a mix there. We've got 5% said before tax, 0 have said after tax, and 95% of you have got that correct. It does depend on the pension scheme. So of course, check with your pension provider if you're unsure. But yeah, before or after tax, it does depend. So question number 2, let me hide that one. And launch number 2. Which is what determines the pension contribution rates? So what determines the pension contribution rates? Is it the employee's age, the employee's wage, the rules set by the pension scheme, or the national minimum wage? What determines the pension contribution rates? Great, I can see those answers coming in. They look correct, so give it a little bit longer. So what is going to determine those pension contribution rates? Great, and I'll close that one now. We'll share those results. So 10% of you have said the employee's wage, and 90% of you have said the rules set by the pension scheme, and that is correct. So if your scheme is already set up, again, you can check these in Payroll. You can check those settings there. And a little bit of a trick question there, because if any of you have been to our other pensions webinars, you'll know that the employee's age and wage are actually used to determine the worker type that they fall into, and that's going to determine whether they're eligible for automatic enrolment or not. But yes, rules set by the pension scheme is the correct answer to what determines the pension contribution rates. Question number 3 coming your way now as well. Let me launch that. Great, so question number 3 is, if the employee's pension contribution is deducted after tax, the contribution is reduced by what percentage? So if the employee's pension contribution is deducted after tax, the contribution is reduced by what percentage? Is that 4%, 20%, 80%, or 5%? If the employee's pension contribution is deducted after tax, the contribution is reduced by what percentage? %, 20%, 80%, or 5%? Great, and I'll share those now as well. So I'll close that poll down and share those results. Lots of percentages going on here. So 1% of you have said 4%, 92% of you have said 20%, 6% have said 80, and 1% have said 5. Correct answer is 20%. So well done to 92% of you who've said that. That's because in a scheme that deducts after tax, there's the 20% basic tax relief. So it's reduced by 20%. So the contribution rate does end up being 80% of what your scheme rate is set up to be. Those answers were kind of to throw you off a little bit. So well done to those of you who got 20%. And last question on today's quiz. Just launching that poll now too, is which of these factors affect pension contribution calculations? And a little tip with this one, it is a multi-choice question, so you can select multiple answers with this one. So which of these factors affect pension contribution calculations? Select all that apply. Is it the employee's pensionable earnings? The scheme's contribution rates? Whether the scheme is deducted before or after tax, or if the scheme uses qualifying earnings for pensionable pay. To which of these factors affect the pension contribution calculations? Select all that apply. I'll leave that one open a little bit longer. So select all that apply for this one. Which of these factors will affect the pension contribution calculations? Great, and I will close that down and share those results. Bit of a trick question, this one. They all apply. They're all factors which can affect the pension contribution calculations. So if you selected all of the answers there, you were correct. But again, remember you can check these in your pension scheme settings and also the pay element settings too, just to see if the pay elements are included in the qualifying earnings and whether or not they're pensionable as well. But well done to those of you who got those correct. Thank you for participating in that quiz as well. Just a little bit of fun to kind of end the webinar this morning. But that does bring us to the end of the quiz, also to the end of the webinar content as well. But before we do wrap things up from our side, we are going to pass back to Duncan for the last time there, just to go over some further support with you as well. So it's over to you, Duncan.
Thanks so much, Alice, and well done everyone that got 4 out of 4 there in the quiz. So just before you go, I want to run through some of the further support that is available to you, starting off with some of our upcoming webinars. So this month has been very much pensions focused, and we do have some repeats of sessions that we ran earlier in the month if you didn't get to join us for them, as well as sessions on pensions data exchange and pension re-enrollment. So you can see some of the dates there on the slide, and you can sign up for any of these webinars at sage.co.uk/webinars. If any of you deal with HR in your business as well, we do also have an HR advice webinar next month on the 6th of November at 11 AM around addressing performance issues in the first 2 years of employment. So always interesting sessions with our special guests from HR Advisor Plus. So if you want to come along to that one, do get yourself signed up. We also now do a one-to-one bespoke training service. So if you are after a little bit more support tailored to your business, we can arrange a one-to-one training session. This could include things such as admin automation, pensions module, or support for anyone new to your business taking on payroll for the first time. If you'd like to know more details and get a quote for a training course for you, do email the team at Sage, UKI Sage University at sage.com. And quick reminder that you can always find help on our online help centre at sage.co.uk/help, or by clicking any help icon in your programme. And we have online courses that are free to complete at Sage University, sageu.com. Create your profile and find your way to the Sage 50 Payroll Learning. We are nearly out of time for this webinar. If there are any final questions that you want to sneak in, pop them in the Q&A now. And a reminder to download the handouts if you would like a copy of those. We will send you a follow-up email later this afternoon with a link to the recording of today's session, so look out for that in your inbox. And if you wouldn't mind completing our survey as you leave the webinar today, we'd love to know what you thought of today's session and the format, and any ideas that you might have for webinars in the future. We do read all of your comments, and it really does help us to keep these webinars the best they can be. So webinar survey should pop up as you leave us today. So what we will do is we'll stick around a little while longer just in case there are any questions that we can pick up in the Q&A. And we will come back in just a few moments when we are ready to close the webinar down. So we'll speak to you shortly. Hi again, everyone. We haven't had any new questions through in the last couple of minutes, so we are going to wrap up at that point. So massive thank you for joining us all on this Friday morning. We do hope you've enjoyed the session. Get yourself signed up to some of our other sessions in the future, but on behalf of myself and Alice, thanks for your time today, and we look forward to seeing you on the next one. It's goodbye for now.